Well, with fresh threats of tariffs, markets reacted swiftly, as we've been discussing. Our next guest, Jeff Schulze, is ClearBridge Investments Head of Economic and Market Strategy. Jeff, it is good to see you. So as Jared was just saying there, listen, U.S.-China trade tensions, Jeff, they're back in focus. You can see stocks sliding here. President Trump clearly sounding frustrated, Jeff. He's threatening these massive tariff hikes on China. Big threats. No specifics yet, Jeff, but big threats. I'm just curious, you saw the post. You see the market response and reaction, Jeff. What do you make of it as an investor?
Well, as Jared mentioned, we haven't had a 2% sell-off in close to 6 months. It's been almost a straight move higher off of the Liberation Day lows. And investors were looking for an excuse to sell, and this is as good of an excuse as any. This calls into question the President Trump and President Xi meeting in Korea at the end of the month. And if the truce is not extended by November 10th, tariffs could move back up to 145%. So that certainly is a real risk. I think that some of this volatility and uncertainty will bleed into next week, which could create more downward pressure in markets. But ultimately, we are buyers of this dip because when you look out to 2026, you have a very powerful policy mix of Fed rate cuts and the peak stimulus from the One Big Beautiful Bill, which is a policy mix that you only see out of recessions.
So you're buying on this dip, Jeff. What would make you question that decision? What would make you question that strategy?
Well, if we start to get closer to November 10th and it doesn't look like things are thawing between the U.S. and China, that means that there is a real risk for a dramatic escalation of trade tensions. And let's not forget, even though Chinese imports are down 30% on a year-over-year basis, it's still the fourth largest trading partner for the U.S. So that would cause a lot of disruptions and it bring back a lot of that anxiety that we saw in March and early April.
So I'm curious, Jeff, so you're buying this dip, you see it as an opportunity. When you saw that headline, though, Jeff, and it looks like, all right, trade tensions ratcheting back up, tariff threats ratcheting back up, heat ratcheting back up between Trump and Xi, does it make you reconsider at all, Jeff, how and where you want to commit capital?
It doesn't. And given the policy mix, as I mentioned earlier, and the fact that earnings expectations are continuing to move higher, not only for 2025, but for 2026, I think you want to be exposed to the more cyclical areas of the market. We like consumer discretionary. A lot of that peak fiscal impulse next year is going to be going through higher tax refunds in the first half of 2026. That's going to support the consumer and consumer discretionary more broadly. We like financials. We're going to get a steeper yield curve as the Fed continues to cut, some looser financing conditions. So we think loan activity is going to pick up, more M&A activity, less regulation. And we also like IT. We think that IT CapEx story is alive and well and will continue into 2026. So what has been working may not be working today, but we think there will be a continuation of that next year.
What about, Jeff, I've had investors come on, maybe more on the skeptical side, who've said, listen, big move off that April low. Valuations are looking too stretched. I mean, you heard Jay Powell himself seem to suggest, he says, we're looking a bit stretched here. What do you say to those? And listen, they would, I think, acknowledge valuation is not a market timing tool, but what do you say to those who do believe we priced in a lot of good news at these levels?
We have, and I think that's why we may see some volatility right now. But ultimately, I think earnings delivery is going to surprise to the upside next year. If you look at GDP now, third quarter GDP is expected to be 3.8% compared to the last 3 months of job creation averaging 29,000. Wage growth continues to go down. What that means from a corporate perspective is higher revenues and a cost structure that's remaining in check, which will ultimately feed through to better bottom line delivery. And I think the markets have started to sniff this out. And I think that earnings expectations are going to continue to move higher next year as this comes to fruition. And it's not just a Mag 7 story, in my opinion. I do think next year you will see that earnings delivery broaden out to some of the laggards, that small caps, of mid caps, value in the S&P 493, which is, of course, without that Mag 7 included.
Speaking of Mag 7, Jeff, I want to talk to you about that just mega AI trade and trend, so critical to this market. You've heard investors, including some very well-known ones, Jeff, throw some caution flags, questioning whether the boom is a bust. How do you think through that?
Well, I think the costs of not investing are greater than the cost of investing at this point. It could be a winner take all type of environment. And the investor sentiment has really kind of looked through all of that free cash flow generation that's being thrown into that AI CapEx cycle. So until there are tangible signs that there is overinvestment and their payoff isn't going to happen, I don't think investors are going to punish the hyperscalers that are investing aggressively into this new technology.
You know, Jeff, we almost got through the entire segment without talking about the government shutdown. I'm going to guess, Jeff, you're going to tell me as an investor, you're looking through that, but elaborate on that for me.
We are looking through it. The markets were looking through it until today's news on China. Unfortunately, we don't have the catalyst of a debt ceiling agreement to bring that government shutdown forward. But ultimately, it does shave about 15 basis points off of GDP for each week that the government is shut down. But when the government does reopen, you do get a little bit of that growth back. So I don't think that this alters my view of the economic trajectory next year. And it certainly doesn't alter my view on the earnings expectations either. So I think this is more smoke than fire.
Jeff, good to see you. Enjoy the weekend.
Thank you.